Hi, good morning. So when we look at the energy system and the financial system, what we have is a large degree of codependency between them, because the energy system requires massive investments to develop new sources of energy. The financial system requires the economy to keep growing, which requires new sources of energy to keep that growth going. And really about 2 centuries ago, when we first started using fossil fuels to a great extent and therefore could facilitate continued economic growth, a new financial system was required. One, to concentrate and direct the vast amounts of capital needed, and secondly, to actually fund the economic growth that was facilitated by those fossil fuels. So from that, what we now consider to be the normal financial system we have was built during that period. So things such as corporations with shareholders, bonds, stock markets to actually trade those instruments, fractional reserve banking to drive the money supply fast enough to fund economic growth, trade finance so people can actually export things from one country to another and be sure that they will get paid for those things, and then project finance for being able to understand the risks involved in very large engineering projects such as a new oil well or the Alberta tar sands type developments. But because the financial system was developed to fund economic growth, it actually became dependent upon economic growth. It has a very tight fit to its current environment. If you look at stock prices, the actual level of the stock price is driven by the assumed growth rate of the earnings of a company. If that growth rate changes, then the stock price can easily fall or rise. And also the payment on interest on debt generally depends upon the economy keeping growing. If it stops growing, unless you've got very high levels of inflation, you can't pay the interest. And high levels of inflation themselves are very bad for the financial system as well. This is a graph of total energy use from 1980 to the present day, showing basically just the correlation between GDP growth and energy usage. And you can see it's very tightly focused after 2000, very much because you've got developments more in China where energy efficiency, I think as a previous speaker noted, has actually fallen relative to the levels of energy efficiency which we were experiencing previously. And then we've got the global primary energy usage, as you see from this graph. Really the world that we know and treat as normal didn't start until about 1950, post-World War II, when the true kind of exponential growth of energy usage took off. And then from the 1970s, 80s onwards, the generation of what we now have as our financial system. If we look at the financial system, what we have is a complex system, just as we would have in biological sciences. And it has the same kind of way of acting when it's pushed outside its normal bounds of resilience. So within those bounds of resilience, it can act and keep itself kind of balanced using negative feedback loops. Once it goes out of those bounded resilience levels, it rapidly, what we call a crash happens as you get self-reinforcing positive feedback loops hitting. And the problem we have is we have a complex, somewhat unsteady financial system which also funds and supports our whole economy. So when I go to an ATM, put my debit card in and get my money out, that same institution is also playing in global financial markets, which puts it at great financial risk. We haven't separated the two things. So the allocation of capital, liquidity, basic payment systems are all based around institutions which are also in extremely risky financial markets as well, which are completely dependent upon ongoing economic growth. And we think about since 2008, in 2008, the financial system basically went into the emergency room. It never left. It still is in the emergency room. When you look at the amounts of liquidity being provided by the central banks continuing, we're talking about reducing the amount of liquidity right now, incremental liquidity being provided by perhaps 10 billion a month in the US. We're not talking about reversing the trillions of dollars of liquidity which were poured into the financial system in 2008, 2009. We're also having governments directly going in and buying bonds and buying equities in some countries as well. Then we have what we call nicely regulatory lenience, where banks have been allowed to not price their instruments accurately in the marketplace because that would actually maybe show that they were not viable institutions, which is a normal thing to happen in financial crises as the banks try and earn their way out of the problem. And then we have the wonderful ZIRP, which is zero interest rate policies. So right now in Canada, I can get a mortgage at 2.99% or even lower. Before the crisis in 2008, that would have been 6 to 8%. So we're finding we cannot operate the economy without interest rates at very, very low levels. And we're now talking about NUP, which is negative interest rate policies, which you'll actually be charged for putting your money into an investment. So if growth ceases, or even if we just contraction ensues, the financial system becomes non-viable. It rapidly moves out of its comfort zone and rapidly crashes. So it actually greatly exacerbates any issues pertaining around the underlying development of the economy. And then you create reinforcing feedbacks, which is the actual energy provision. So what you have is two systems, the energy provision system and the financial system, which can both drive feedbacks. The financial system, if it crashes by itself, can remove funding from the energy system, which needs large amounts of large-scale investments, and therefore reduce the provision of energy to the economy and to the financial system, which will then feed back into the crisis. The other way around, if we have limits on energy provision, then the financial system itself will start to become impacted because economic growth will cease. Hopefully not contraction will go into place, and then the financial system will crash, driving back into the energy provision. So what are those kinds of impacts at a detailed level? So first of all, we'll have an inability to fund the huge capital investments required to drive ongoing fossil fuel development. And in some cases, we're starting to see that. So if you look at ExxonMobil, Royal Dutch Shell, etc., you're seeing that the amount of debt these companies have taken on has sharply increased over the past 4 or 5 years as they've doubled their investment budgets. There's actually some questions now in most of those companies. They're thinking of actually reducing their investment budgets because they're not getting the financial returns they need to actually go back and get more debt and load up. So that's actually the part of the feedback loop already happening. Then, of course, you've also got impacts to the ability to invest in renewable energy, which tends to require upfront investment, and then you get an annuity stream afterwards. Whether it's, the biggest one will be building a hydro dam, but even building a windmill, you first of all need to build the thing, then you get the electricity afterwards. And we have, if we look at the IEA, they've estimated between now and 2035, we need to invest about $40 trillion to basically meet the energy requirements of the economy. Now, that's rather, how do you work out how big that number is? Well, the US economy is about $14 trillion. So we need to invest the next 20 years 3 times the US economy in investments. And that's about $2 trillion a year. So it's a huge amount. Can that actually be met given the kind of strains that we're seeing? Then also we have the inability to provide working capital and trade finance. Companies need short-term working capital to keep just doing their general activities, but also you need trade finance because even to build, whether it's renewable energy or fossil fuel energy, there is a myriad of very complex supply chains which have to operate. They need trade finance. Every small company along that supply chain needs working capital to keep it going. Then if you actually have a crash, and we saw this in 2008 for a short time, where trade finance dried up for a while. You had ships sitting outside Singapore harbor, couldn't go anywhere because they couldn't get trade finance. Then, in addition, all you need is a few parts of those global supply chains to become impacted. Maybe they go bankrupt, maybe they just can't get funding, and suddenly you're unable to carry out the larger projects that you need to, as the financial system is the way of coordinating those very complex global supply chains. Then also, you have the possibility of severe social impacts, because what we call wealth is a claim upon future production, future economic output. If our view of future economic output is incorrect and it doesn't take place, then that wealth is a mirage. Well, that mirage is people's pension funds and insurance companies' portfolios, etc. So the economic impact of that and the social impact is quite great. So we're really, if we don't operate within certain bounds in the financial system, we very rapidly get into trouble, which then cascades through the economy and will also cascade through the actual energy supply system as well. So to summarize, The financial system, as it is currently constituted, will provide positive feedback which exacerbate any kind of crisis. Also, given that it's also never come out of the emergency room, it may provide a crisis all by itself. And a good metaphor, I've heard one person say, it's as if a farm worker had their leg crushed, was rushed to hospital, and was bleeding to death, and the only way they could stop the bleeding was to cut the leg off. But instead of cutting the leg off, they just kept pouring blood into the guy. Well, sooner or later, that man will die. You're just taking a much longer and much more painful process to let it die. That's the position we're in with the financial market right now when you look at the amount of emergency measures which are still in place, let alone reversing all the ones that have been done in previous years. Another important thing also is the financial system acts with a bit of a twist like a time machine. So it takes our perceptions of the future and realizes those in current prices. So our perception of how fast the economy will grow, how fast an individual company will do, how well an individual will do so they can pay the mortgage on their house, affects the financial prices of those instruments today. So if perception changes, suddenly the prices change. That's why you have high volatility in financial markets, because the perceptions can change much faster than reality. So if suddenly the perception changes that maybe there are limits on actual energy supply, then the financial markets may act very rapidly with only probably 5 to 10% of the participants having that view. It's enough to change the market over to a different state. Thank you.